Welcome back. The market posting a sharp gain today with just about 45 minutes left in today's trading session. Despite all the talk about the recent stock market rally, bonds also getting a lot of attention in a different way. Goldman Sachs, one of the biggest treasury bond bulls on the street, now saying that the rally has seen its peak. Goldman says the best trade going forward is to buy stocks, not bonds. Also, FDIC Chairman Sheila Bair telling CNBC there is a bit of a bond bubble developing. The bond bubble theory gaining traction. Question is, are small investors taking too big a bet on debt? With me now, Tony Crescenzi. He's Senior Vice President and Portfolio Manager at PIMCO. Tony is author of the book, The Strategic Bond Investor. Also with us is Andrew Schiff, Investment Consultant at Euro Pacific Capital. Andrew is co-author of the book, How an Economy Grows and Why It Crashes. Gentlemen, good to see you. Thanks so much for joining us.
Thanks, Maria.
Nice being here.
So, Tony, let's kick it off with what's happening in the bond market. Jim Rogers was with me yesterday. He says there is absolutely a bubble. Sheila Bair hinting toward the same. Even Warren Buffett says the stocks are cheaper than bonds right now. Why are you convinced that there is not a bubble in bonds?
Well, there are a lot of reasons. For one, let's think about valuation. When you value bonds, you have to compare the yield to the inflation rate and to the Fed funds rate. Of course, there's a pretty wide spread still. If you expect that the inflation rate will fall as we do to, let's say, 0.5%, then the 2.5% 10-year doesn't look out of whack, so to speak. And the funds rate, of course, is going to stay around zero for a long time. Secondly, think about demographics. What would a 60-year-old think in terms of where to put their money now? They've lost wealth, and they probably did lose wealth in the dot-com bubble bursting, the financial bubble bursting in 2000. They lost money in their homes and, of course, in equities recently as well. And so where would they rather be? They probably would rather be high in the capital structure, as we like to say, in assets that are more likely to preserve their money. And there's more of that lately, of course, with the savings rate rising. And so for these reasons in particular, and the insurance element, and given the safety of corporations these days, given the cash they have in hand, it does not quite seem a bubble at all.
Yeah. So, the head of Treasury and derivatives trading, Steve Rudofsky, said today that the best day in Treasuries is probably behind. So the game plan is to get more neutral on Treasuries. Do you agree with that, Tony?
I believe in anything that the master Steve says. Yes, Steve, of course, is discussing the Treasury market. The bond market, of course, consists of many other segments. We have to think of corporate bonds and municipal bonds and emerging market debt and asset-backed securities. So we're just expressing a preference for other types of securities relative to Treasuries, not that yields in their entirety will rise, but that perhaps Treasuries relative to other securities won't fare as well because perhaps the best days are gone. And one last thing on that. Remember, we've been on a 30-year journey with Treasury yields, where the 10-year was around 16%. Of course, it's now much lower than that, and it's about as far as it can go on the downside. But when we look at Japan, of course, it can go lower. And so when we look at the bond market going forward, we have to think beyond the duration tailwind, as they say, beyond just trying to stay long Treasury securities, and look at the things that PIMCO has done for a long time, which we call risk factors.
Right.
And very many things you have to do to manage the risks in a bond market environment.
Meanwhile, Andrew, you're a believer in this bubble theory. You call this the mother of all bubbles, right?
Sure. And David Tepper last week said you got to believe the Fed, and we don't agree with them, but we do believe what they say when they say something. And they clearly have said that they're going to try to create a lot more inflation. Right now, they see the PCE at 1.5, as Tony had mentioned. But they say that's too low. Apparently, there's a new floor of inflation that they have to push. They have to get above. I don't know where the ceiling might be, but it's going to be higher than 1.5, not the 0.5%. So knowing that, you're looking at buying a 10-year Treasury bond that's clearly yielding below the rate of inflation. And when you factor in the falling dollar, which, of course, as the quantitative easing takes hold, right now the United States is involved in a race with other countries to the bottom to try to devalue their currencies faster. So if you're going to lend money to the government, as Jim Rogers said, for 10 years, you're going to expect a little bit more return than the two and change that the 10 years offering. So it's a terrible investment. That 60-year-old you talked about needs to have some income, and he's not going to find it in Treasuries. He's not going to beat Treasuries. So right now, the only buyers you have of Treasuries are the short-term speculative buyers, either the governments that are buying Treasuries for political and macroeconomic economic reasons, or the hedge fund investors who know that there's a bid on treasuries that the Fed is putting in, and they know in the short term they can't lose. But this quantitative easing destabilizes the amount of treasuries in the long run, creates more inflation, so it's a horrible long-term bet. Anybody who wants to live off of income can't do it on treasuries. They can find higher dividend yields on stocks, certainly around the world. You can get a 4 or 5% dividend yield on select foreign stocks, and those dividends can go up, and those are priced in companies can rise with inflation.
Yeah, I want to play you what Jim Rogers said yesterday. Tony, I'd like to get your reaction to it. We were talking about the bond market and how much money has gone into the market here. Listen to what Jim Rogers had to say.
There is a bubble forming. I mean, I cannot conceive of lending money to the U.S. government at such low interest rates for 30 years in U.S. dollars, but somebody's doing it. I'm not shorting bonds in any significant way yet. I'm waiting, but I don't know how long I'll wait. Probably the last time I was here, I said I'm waiting,
yes,
and bonds continue to go up. I'm still waiting.
And in fact, today we've got the market, the stock market right now at the highs of the afternoon. The Dow Jones Industrial Average right now is up 210 points, guys. And even with money moving into stocks, it's once again moving into bonds. So Tony and Andrew, Tony, you first. Give me a portfolio and what it should look like with exposure to bonds, stocks, and any other asset class you deem appropriate.
Well, of course, it depends on the individual, but what investors need to do is be very forward-looking. In bonds, of course, there are indexes that money managers are judged against. These are market cap weighted. In other words, the more treasuries there are outstanding, the more gilts there are in England, etc., the more an investor is exposed to these countries. And what investors need to do is expose themselves to the countries with rising incomes and rising income prospects. And so those would be the countries such as in Latin America, in Brazil, where the median age is 29, and hence they have a good ability to repay their debts. Where they have high real interest rates, of 5% real interest rates, that's the rate of the bond minus the inflation rate. They need to be forward-looking, like a banker would. Where would a banker give his or her loans to? Those with rising debt-to-income ratios, or those with improving income prospects relative to their debts. And you'd rather, of course, give it to those with improving balance sheets. And so one needs to invest in that way, both in equities and in bonds, and be very forward-looking and know that this is an upside-down world.
Yeah. Andrew, real quick, you want to add to that?
Well, it's really simple. I mean, we had a good day in the markets today, but we had a terrible day for the dollar. So when the dollar falls, everything priced in dollars is going to go up. I mean, I have a bag of potatoes in my refrigerator that probably had as good of a day as the S&P 500. So you have to understand what's pushing up all asset prices, which is an overt currency devaluation happening in the United States and Japan, other places in the world. For investors, you've got to look for better currencies. You've got to look for some real yield, and you got to get out of the way of inflation. You want to put the risk trade on because of inflation. You know it's out there, so play it. And there is good value in stocks around the world, and if you look for them, you can find them.
All right, gentlemen, thanks very much. We appreciate it.